talking about Roth accounts, how to have more.
It's better than that. It's the mega backdoor Roth. This is,
which if you didn't know is how you can get more than 60 grand per year into a Roth account that can come out tax-free at retirement.
And you can self-direct it and invest in whatever the freak you want.
And I don't have to just buy mutual funds.
Yeah. And I had a phone call with a client yesterday. We were talking about the charitable remainder trust. We're doing some additional strategies with CRT and some crypto and some real estate. And the client said, and they go, and his wife was on the phone and she's like, well, I want to do a Roth strategy too. Can we do that inside of CRT? And I go, no, they're kind of brother sister. We do the Roth over here and we do the CRT over here, but they can work in concert. And we talked about some strategies there. And then they go, well, hold it. How much can I put into a Roth? And I said, with the mega backdoor Roth, freaking over 60 grand. And they were like, brains blown. Yeah. And then the husband said this, well, I can't get to it till I'm 65 and I'm 55 now. I don't want to wait 10 years. I go, whoa, whoa, whoa. You can access the Roth IRA at 59 and a half. It's like a tax-free ATM. Just pull out whatever the freak you want at 59 and a half. He goes, what? I go, have you had the Roth for at least a year already? Yeah, I've had a Roth for a while. It's only got a few thousand in it. I go, 5 years or 59 and a half, whichever's earlier.
Yeah.
It's all yours, baby.
But also here's the cool thing about the Roth. The contributions you put in can come out tax-free whenever you want. It's the earnings and growth. You got to wait till you're 59 and a half.
And this is why we're doing the mega backdoor Roth today, because it's like the Roth on steroids. So, and the Roth is steroids on top.
The Roth was on steroids and also worked out every day. That's what it's like. We want to make sure you know what the heck a mega backdoor Roth is. That's how you can get over 60,000 per year into a Roth account. I know many of you are like, I thought I could only do 6,000 or maybe I can only do 20,000.
I can't do anything. I make too much money. I make too much money.
Exactly. Yeah. No. We're going to cut through the BS and let you know how you can do it. And go over the strategies and how it adds up. And this, let me say this. This is why you got to know this stuff and be informed, because a lot of people are going to give you the quick, easy answer of just no. Because when people don't know, your financial advisor, your CPA, they're uninformed. They want to just say, no, you can't do it. Because they're going to look like a moron when they try and tell you how to do it, because they don't know. So we're going to teach you. Here's how you do it. We're going to go through the technical rules on how it stacks up where you can get to over 60,000 a year.
All right. Now in the mega backdoor Roth, it all starts with the basic Roth, and we've got to dispel some myths. Matt, what does this tell us?
All right. The first thing you're going to do is you want to put $6,000 in a Roth IRA. And the myth Mark's talking about is a lot of people know if I'm high income, I can't just drop $6,000 into a Roth. And we got the slide here outlining what's high income here. Just for those on the podcast, have the benefit of seeing the video here. If you're making over basically 200 grand married, 125,000 single, you're going to be phasing out on this. And you can't go in what we call the front door for a Roth IRA, but there's another door.
You see 6,000 or 7,000. So we've got to make that distinction that if you're under age 50, it's 6 grand. If you're over 50 or older, it's 7 grand. And so what a lot of CPAs say, or financial advisors, is you make too much money, you can't do a Roth. And they don't tell you a couple extra strategies or rules, which we're going to unveil now. But before we go to the next slide, I want to point this out too. Some people go, well, I'm too old. You're never too old to do a Roth, period. And then people go, you said you could do this with your kids? Yeah, I've got kids that are 2 years old with a Roth. All they have to have is earned income. Now you got to have a unique scenario with the small business that could.
The 2-year-olds, maybe they're, the child actor, but you got to have, but definitely your teenagers and those people working the family business are great for the kid Roths. They have income or they got their summer job or whatever.
The point is, again, any age, 2-year-old or 92-year-old can have a Roth IRA with a little earned income. So that myth is dispelled and we don't care what your income level is. So here's this next slide, Matt. Show us how this works.
Yeah. All right. So I said, you can't go in the front door. So what we're going to do is this is called the backdoor Roth. And you may have heard news, the backdoor Roth IRA is getting closed and shut out. There's legislation on that last year. It didn't pass. The backdoor Roth has not been locked shut. It's still open. You can still go through it. All right, guys. So what the backdoor Roth means is you don't qualify to make a deductible traditional IRA contribution if you're high income, but you can still make a traditional IRA contribution. It's just non-deductible. Well, why don't I make a non-deductible traditional IRA contribution? I'm high income and I'm going to convert it to Roth. You can convert non-deductible traditional contributions over to Roth. And so that's all we're doing. It's kind of this two-step process. It's commonly known as the backdoor Roth. We have prior podcast episodes just on the backdoor Roth. But this is an important one because this is the easy one for a lot of people that are just like, guys, I don't have 60 grand to throw in every year, but I got 6. Or even if you're like, dude, I got as much as I can throw in. Well, let's do this mega backdoor 401k Roth and the Roth IRA to get to this even higher number.
Okay, but notice off to the left on this slide, we were told by our current CPA or financial advisor, can't do it. They're wrong. Yeah. Now, notice the little however. Now, for those, again, listening, I'm pointing out the different sections of this slide, that this is why a lot of financial advisors will say you can't do it, because they're thinking 2 steps ahead and don't tell you this, but it's a fair point, is that if you have old traditional IRAs again, you have to convert those to Roth first. But what they don't say is, let's see if we can crack the code here. What could we do with that old IRA? Oh, we could roll it into a 401k that you've got sitting over on the shelf here, and that rule is gone. Or, hey, do you want to do some chunking and convert some of that other IRA? Yeah, I would, Tom. Yeah. Okay.
Well, you probably want all that to be Roth anyways, right?
Yeah. So they don't take the time to say that there's some ideas here that could work, you know? And so it just drives you crazy. All right.
Yep.
Okay. Now the next slide. Oh my gosh. This is step 2. Okay. In the stacking to get to the, okay, I'm going to show the slide just so you know where we're headed. This is the coolest slide. This is the mega backdoor Roth cylinder of power. Okay, so this is going to show you how we stack this bad boy up and we get to our levels. Okay.
Yeah, and just so everyone listening again on YouTube, we're adding up how these numbers add up to get to the over 60,000 here we're talking about. So there's really 3 little amounts in the cylinder of power.
Cylinder of power. Okay, so we got to go back to the grid spreadsheet here, and step 1 was get your Roth 401. Step 1 was get your Roth IRA funded. And if you need to convert some old traditional money, do it, or move it to a 401k and back and get rid of that rule. But step 2 is, okay, now I've got to use the 401k strategy. Okay, now in this grid, for those of you listening on the podcast, and what I'm showing here is within the 401k, there's 2 or 3 pieces, which the cylinder of power will show you in a moment. Yeah. The first piece is, okay, I'm setting aside your Roth IRA. Okay, that's really the first step. But in the 401k, there's kind of an ABC. The first part of the 401k is your deferral. You know, how much do you want to defer? Now, you might be doing a little bit of deferral at your day job and getting a match. Love it. We call that matching out. Get the match, get the hell out. But then in your solo 401k, if for those that have that strategy, you're going to do the rest of your deferral in your solo, or if those of you that just have a day job, you're going to defer your entire amount, even if you don't get a match on the whole thing. This year, the diagram shows $20,500 if you're under 50, $27,000 if you're 50 or older. Then part B of the 401k is this matching thing. Now, why I say there's a B and a C is if you're at a day job, they're only going to match up to so much. So we've got to add another piece, which is called this non-deductible 401k contribution. Or if you have a solo 401k, you might do it through a match strategy with your S Corp or this non-deferral. Now, I know I just said a lot of things that sounded gobbledygook. Be patient with me. But what I'm just trying to say is the 401k is not just one check. It's made up of 1, 2, or 3 pieces to get that next, because we got to stack this thing to get to that mega backdoor amount. Some of you would just like say, oh, where do I write a check? Yeah, it's not that easy. So you got to be patient with me. Okay.
And it does take kind of like the backdoor Roth IRA we showed, where you're making that non-deductible contribution, you convert to Roth. In the 401k, it's actually called after tax. It's similar in that you don't get a deduction on it, but it's this
Mm.
after-tax contribution, which you make a Roth conversion on. So it's kind of like once I did that 20,500 of straight Roth, now I'm doing after-tax contribution converting to Roth. It's kind of a similar process.
Now here is the cylinder of power. All right, now this is the under 50, and we've got the 50 and over. So just under 50. Let's show what this looks like. So the first thing is the bottom portion of the cylinder is your individual Roth. We already talked about that. You're under age 50. Here's your $6,000.
Yeah.
Then you got your 401k employee contribution that can be straight Roth. That's easy. There's no conversion, just straight.
Yep.
Matt, what's your take on this? See this little match thing? It's like, what's your take on that?
Well, some of you, let's say you have the day job 401k, right? They're throwing in a match likely in that, but you can convert that to Roth. Let's say maybe they threw in 5,000 of a match on your 20,500. You could convert that $5,000 to Roth. Boom, right there.
Yep. Okay. Now,
but if you don't, let's say they don't match anything. They're like, you're on your own. You want to throw in money. And there's some 401ks like that. Then you're just at the 25, and then we keep going up the cylinder here because we can still get more in.
Everything you're putting in is either Roth or going to be converted to Roth. And that's okay. Now, in our cylinder of power, individual Roth at the bottom, then your deferral, get any match you can, fine, if the employer does it. Then you go up to the last piece of the cylinder. And this is what Matt clarified for me earlier, and it's properly typed here. It's called the after-tax employee traditional contribution. The reason why I like this than a match, if you're in a solo 401k, is you can take a lower salary and get there.
Yeah.
See, a lot of people say, oh, if I do a match, it's 25% of whatever my salary is on top of my deferral. Well, this is a new strategy we've learned at our accounting and law firm in the last 2 years. Is over to the right side, you can see that if I take an optimal payroll amount of $66,000, I can defer almost the entire thing into Roth money by doing this after-tax thing. Now, if you need to take a bigger salary because your company made more money, take a bigger salary, stay out of hot water with the IRS. But if you have some flexibility to take a lower salary, your sweet spot here is 66,053.
Yeah. And remember, that's going in. Now, this is on your W-2 too. And so you've got to have the earned income also. So you've got to at least have that amount of earned income. This is whether you're self-employed, doing the solo, or you got the day job, 401k at Dunder Mifflin. And so you're able to do this both. Now, most 401ks, like definitely our solo K allows for after tax. Most company 401ks actually allow for after tax. It's more the exception that a big company 401k does not allow the after tax. So it's pretty widely available is basically what I'm trying to get at here. It's just learning how to execute it and pull it off that sometimes that's where you can get tripped up. You call HR, your 401k administrator at the day job, and they're like, I don't know. Or they say no because they don't know how to do it. So this is the strategy. And the hard part really is this after tax amount, because it's got to go in as after tax. It's on your W-2. Or actually, is it not on the W-2? I think we actually realize it's not on the W-2. Is that right? The after tax?
Oh, the after tax is in box 13. So it's a box on the W-2.
Yep. Okay.
And for you accountants out there, you want to make sure. Okay. So all right, let's get technical.
This is going to get geeky for a minute. I can tell.
You see the geekness coming.
The king of the nerds is coming out.
Yep. Here it comes. Here's the geek. Okay. Right now it's April. We're recording this, April 12th, 13th. It's going to go live today, tomorrow. We want you to have this in before the deadline, and make sure all of you come to the summit next week after the tax deadline. But let's get real. Notice up in this slide, it says 2022. The reason why is you've got to plan for this no later than January of the year you want to take of the prior year. of the subsequent year you want to take advantage of it. So if you want to do a mega backdoor for 2022, you're going to be putting some of this information on your W-2 in January of 2023. Because see, this is ought to all add up for 2022. And that's why we're sharing it now. Now you can do some of this mega backdoor for 2021 still, but if you missed some of this on your W-2 3 months ago in January, the ship already sailed. So we can't get the entire 61 grand in this example, or 67 grand if you're under age 50.
Yeah. But you could maybe do the employer contribution and convert that to Roth for if you're looking at 2021. So there could be a couple things you could do because employers not due. And again, it's going to turn on your salary and everything. But let's say you had $100,000 W-2, that's 25 grand you could throw in as company match, employer contribution. You convert to Roth. Again, not the regular way to do it because it takes a higher salary. But I'm just saying it's a save for those of you that didn't get this right in 2021 yet.
Yeah. And literally, I have a call with a client right after this that is literally saying, okay, what do I put in my 401k? Because see, the cool part about this is if you're planning properly, you can put the numbers on all the right forms in December, January, up until April 15th, whatever. But you actually don't have to put the money into your 401k until the date you file your tax return with extensions. So if you extend next week on April 18th, and you've put the numbers in the right spots on your W-2, you're okay. You still have time to put the money in. So anyway, that's the bad news. So you CPAs out there, make sure that you're putting these numbers in the right boxes on the W-2 in January for the previous year you're trying to pull this off. Does that make sense?
Yeah. Yeah. And those with like the day job 401k is a little more trickier because you don't have a lot of flexibility. You're dealing with HR and your W-2's cut, you know, they ain't getting the change. So you got to be on it. But those you self-employed, you get a little more flexibility because, you know, you're the boss.
Okay. Now here's the climax of the show for those under age 50 is look up in the top right-hand corner. Your maximum Roth for this year in 2022 can be $67,000 each. If you're married.
Yeah.
Oh my gosh. You just did $134,000 in Roth as a married couple. Now,
that's awesome.
Some of you are like, I don't even make that much money. That's all right. Someday you will. That's the beauty of the
American
dream.
You can work your way up in the cylinder of power, you know? It's just, that's okay.
All right. I'll let Matt show the next slide, you know, climactic moment here up in the right-hand corner of those 50 or older. Where are we at?
Yeah. The cool thing about those 50 and older is you get to put more in. The IRS is trying to incentivize those 50 or older who want to throw more in to put more in.
Plus we're smarter.
That's right. You know,
we're a little more, you know, seasoned.
Yeah. A little more, they have more wisdom. Yeah. You know, I don't know.
We're there for you. But you also get to put more. And what's the number?
So on the IRA, you get an extra 1,000. So instead of 6, we're doing 7. But on the Roth 401k, we're able to do 27,000. That's just the straight Roth 401k employee contribution, as opposed to the 20,500. And so what that allows me to do here is now I'm able to throw 74,500 in on a mega backdoor Roth at the end of the day. Again, if you got a spouse over 50 working in the business too, you both could be doing that and throwing almost 150 grand of Roth new contribution dollars in each year.
You know how sly Matt is? I mean, this is that slick Willie attorney in him. Notice how he said, you could be doing about 150. See, he didn't want to do the math of 74,500 times 2 because he was like, I don't want to go there.
And 149,000 doesn't sound as cool either.
Yeah. It's really 149, but you know, he was like, about 150. You know, what's
he said about?
What's 1,000? 149, 150.
You know,
tomato.
I'm not an accountant. I gotta do the fuzzy math. It's close enough.
Everybody, that's it. I'm gonna stop sharing the screen here, and just summarize with there is a mega backdoor Roth that exists. Yeah. It is not a unicorn, whatever. This is for real. It's real. You can do it. Again, this is a Roth IRA that you can self-direct. There was a lot in the news this last year with Peter Thiel and his $3, $4, $5 billion whatever Roth IRA that he started in PayPal and Facebook and all these things. you can do the same thing with your Roth. You can invest in any type of small business that you're excited about, crypto, real estate, startups. So get out there, use your retirement account, and get to the Directed IRA Summit. It's for real.
Yeah.
Tell your accountant.
Yeah,